Welcome back to this special program. We're calling it the Big Global Reset under Trump 2.0. Louis Gav of Gavkal Research is with us. Manish Bhandari is with us as well of Vallum Capital. And we are continuing our global conversations. Louis, China, let's just finish that point when we took that break, right? You think the Chinese rally, and we've had many false starts over the last couple of years. DeepSeek changed the game in that sense. It also sort of shined the spotlight on how innovative China is at a lower cost level. And it's not just the factory of the world, it's not the cheapest producer, but technologically they seem to be right up there. Do you think the rally is durable in China? I
do, because to your point, I think first there's a change of perspective where all of a sudden you do realize in industry after industry, China is now a world leader. And it's not just on cost, it's also on quality, to the point you just made. But that's not it. That's part of it. That's not just it. I think what we also have to acknowledge when we look at China is that bond yields in China are basically the lowest bond yields in the world. And this is an economy where the pool of domestic savings is just gargantuan. It's enormous and keeps growing. China's running 1.1 trillion annual trade surplus. Now, in recent years, a lot of this money that kept coming into China through the trade surplus, guys would earn it and they would put it in bonds earning 3-4%, or they would put it in real estate, or they would buy gold. Fast forward to today, bonds yield nothing. You get nothing from the banks. Real estate has had the troubles that we know. And then finally, gold is starting to get a little bit expensive. So the default mode is shifting from I buy gold and I buy bonds to I buy equities. And so when you look at today's bull market in Chinese equities, it's not driven by foreign investors, which is the false starts that you alluded to in the past. It was like, oh, maybe Chinese equities are going to be good. Foreigners come in. Yep. After 6 months, they get disappointed. They walk out. This is driven by domestic investors, which in a sense is reminiscent of the bull market you've had here in India over the past decade, which, yes, was driven some by foreign flows, for sure, but was really initially started by domestic investors. Yep. And domestic investors that have, kept going and kept going and kept going, we're just at the beginning of such a trend in China.
They're still going.
They're still going, and yeah, no, absolutely.
I have an observation here. Yep. There are 273 times in the last 2.5 decades where Chinese markets have gone up by 10% and then again fizzled out. Yep. There have been close to 43 instances that went up to 50% and then again fizzled out. Yep. So in most of these cases, you said that a domestic investor was never a buyer?
No, that's a fair point.
Yep.
Of course, you've always had buyers. What's always crushed the big market, the big rallies, the 50%, because now we're, if you look from the bottom, we're up like 70% from the bottom. So we're now at a big rally. What's always crushed the big rallies is one of two things in China. The first thing is either massive issuance from companies. Companies say, oh, you guys like this paper? Here's a bunch more. So you get IPOs, et cetera. Now you could say, well, BYD just came out today doing a $5 billion issue, but at the margin, it's still very no IPOs, not much in the way of IPOs yet. The second thing that crushes it is the government gets worried about too much speculation and comes in and puts in controls on margin requirements and basically signals parties over, everybody back in the classroom. So far in China, we have neither. We have neither. We have a government that is still pushing the market higher, and we really haven't had a big proper IPO cycle. Okay. The sign of the top in China, for me, will be probably 6 to 12 months after you get the Alipay, the ByteDance IPOs, like all the big names, and all these guys come in. That's when you want to start thinking, maybe I get my hat and I go home.
What does the Chinese, so you're saying it's a proper bull market in China?
I think it is.
It's the beginning of one, essentially, yes. Right? So it's not just going to be tech, it's going to be everything. Slowly it'll broaden out.
Well, actually, this is interesting. Most people have missed this Chinese bull market because up until this DeepSeek thing, tech was not participating, right? Like Baba had gone nowhere, and JD had gone nowhere, and Tencent, et cetera. But if you look at the past year, last year, few people realized that FXI, the biggest China ETF in the US, FXI actually outperformed the S&P 500. While tech was flat for the year, it was the banks and it was all the big SOEs, because what you saw in China was as bank deposits started to yield zero, people started to say, zero at the bank, I can buy PetroChina yielding me 6.5%. I'm going to start doing that because PetroChina isn't going to go bust. Bank of China isn't going to go bust. ICBC isn't going to go bust. And so you start to see some of the flows that way. Now what you're seeing is tech is actually catching up. And now the next step is the government keeps saying we're going to do big consumer subsidies in the coming 6 months. Everybody's waiting for what those are going to be. But consumer stocks are now starting to go as well. So now you've got the high yielders, i.e. the banks and the SOEs. You have the tech and the consumer stocks. So yeah, it is broadening out.
Will it come at the expense of India? Flows?
Well, I think that's already somewhat happened, to be honest. Like, when you look at the past 6 months, obviously the Indian stock market has struggled.
Right.
And it's struggled not because domestic investors have sold, but because foreign investors have sold. You've had, I think record outflows actually for India. Now, I think, Manish, you made the point earlier that an environment of, falling yields in the U.S., stable oil, falling U.S. dollar, if you're the RBI, it's happy days, right? It's like you couldn't ask for more. This is perfect. It also means an environment where, if at the same time, the bull market on Max 7 is over, you start to see allocators start to allocate to emerging markets. Now, I think the big story on emerging markets in the past decade was that India was the only good story. Like Russia was obviously you could invest. China was said to be uninvestable as well. Brazil had political problems. So India was the only place. So India got a very big piece of the shrinking emerging market pie. The next 5 years, you're going to see a rapidly growing emerging market pie. But the India piece might shrink, but the piece of the pie will still be bigger than what it is today, if that makes sense. You're going to get a smaller piece of a much bigger pie.
Which is still more.
Which is still more, which is still a bull market.
Unintended consequences of Trump's policy. Yeah, that's right.
Absolutely. Let's talk about commodities, which is the other leg, right? Do you think they're starting something here?
Look,
commodity prices?
Yes. Look, I spent a lot, as you were based in Hong Kong, and I spent a lot of time looking at China. We have an office in Beijing. I spent time there. In my career, each time the Chinese economy started to reaccelerate, because it is such a big economy, it had a positive impact on commodity prices. And all the more so in recent years, because when China does better, you see immediately the impact all across Southeast Asia, all across Latin America. So when I look at the coming year, I think, okay, China's doing better. Southeast Asia is going to do better. Latin America is also starting to do better. India's humming along. Like, I know the stock market hasn't been great, but the economy's humming along.
Yeah.
You put all this together, and it doesn't tell you that, oil's going to $150, but it tells you that the pressure is to the upside, not to the downside.
But not gold so much, right?
So
We talk
gold,
about industrial commodities,
Yes.
the upside, but gold, which has already had a fantastic bull market, you think we're in the last stages?
like I've been a raging bull on gold, and so it's always hard to change your stripes. My concern on gold is pretty simple. I think if you look at the past 3-4 years, you've had two new marginal buyers. The first new marginal buyer were the central banks. When the Western world confiscated Russia's reserves, everybody said, okay, I'm not going to buy treasuries anymore, I'm going to buy gold. And you saw Saudi Arabia, Thailand, Indonesia, China, all the central banks bought gold. I think that's still there, and I think that stays. The other massive buyer of gold were the Chinese retail investors, who had no confidence in their stock market, no confidence in their real estate market. And gold was by default, and especially in the past year, because yields moved to zero in China. So it's like, okay, what do I do with this cash? Boom, I buy gold. If now they start to say, okay, actually, forget gold, I'm going to buy equities, because equities, the momentum is there, they're cheap, they're paying high dividends, I'm just going to do that, then you lose one of your two marginal buyers. And you do this at a time when, frankly, gold is now pretty expensive relative to oil, relative to silver, relative to copper. So I think within the commodity space in the coming year, there's going to be more exciting stories than gold.
Is the silver new gold?
So, look, I'm more bullish silver than gold. I'm more bullish silver than gold because I think there's a number of factors that are going to drive silver higher. One of them, of course, is the world I'm describing where Asia starts to do better. It's silver more cyclical. I think what everybody underestimates is Europe is now moving from 12 years of fiscal consolidation to now big fiscal expansion. That's the big result of the German election. And where they're going to be spending money, everybody thinks it's going to be on defense. I think it's going to be on energy transition. Because when you lose the US protection, yes, you lose military protection, but you also lose the guarantee that the US will always deliver oil for you if you need it. And so I think Europe is going to double down on energy spending, and you can't do energy transition without silver, you can't do energy transition without copper. I'm much more optimistic on those two, constructive than on gold.
Manish, the world that Louis is describing is, we can live with that, right? Lower dollar, lower yield, lower US yields, lower cost of borrowing. You would agree with that?
Yeah, no, absolutely. So as I said, it's unintended consequences of what Trump is trying to do, and this creates another bull market in the emerging markets if Louis' prophecies are going to come true.
You think we'll get a proper bull market?
I think so. I think it's already started.
Yeah.
To your point, emerging markets have been, a laggard and a dullard because you had problems in a number of the big emerging markets. And again, I know India was doing great, but you looked everywhere else. China was terrible.
Yeah.
Brazil was terrible. Lots of issues everywhere. And, you look at country by country, and the outlook is just better. And yes, to your point, Manish, like if really the Trump government comes through with its policies of weaker dollar, weaker bond yields in the U.S., fiscal consolidation in the U.S. while everybody else is doing fiscal expansion, I think the outlook for emerging markets, we're starting a new bull market. This is where the new bull market is going to be.
Well, I think on that very optimistic note, Louis, we want to wrap up this conversation. Thank you very much for dropping by to our studios. Manish, thank you very much for arranging this and being here.
It's my pleasure.
With us at CNBC TV 18 as well. Thank you, gentlemen.
Thank you very much.
Well, I think that gets us to an end in this conversation, but I think we'll have to have many more of these chats over the next 4 years as we continue to deal with announcements, pronouncements, changes and whatnot. So keep it with us here at CNBC TV 18. It's a wrap for now. Thanks very much for watching.